You're in a bubble if, when the price of the stock goes up, demand for the stock increases. When that happens, you've got a choice. Are you going to ride the bubble as far as you possibly can, or is good enough good enough? If you don't do that, when the bubble bursts, there are two categories of investors, the quick and the dead.
So for those of you who just joined us, welcome. This is the Race Summit 2024. I sort of, for our LPs in the room, this is going to be a repeat. Really, like every year when we plan this, it's like planning 10 weddings at the same time. So welcome to my wedding. And we particularly pick Berkeley because Berkeley is the birthplace of Databricks. So many of you may or may not know we're investor of Databricks and also OPIC, and also birthday of Anyscale CRISPR, and maybe the atomic bombs, and the all-gender bathroom. And so Berkeley is a very, very special place. We love Berkeley. And of course, many of our friends went to Berkeley, like Alfred Chu here, Alfred Jr. And so you can ask him about what's going on in Berkeley. But in the next couple hours or so, I'm going to start with a conversation with Bill Janeway, who is many, many things, the author of Doing Capitalism, Innovation Economy, also a special limited partner of Warburg Pincus, also the seed investor of BEA System, and many, many things. And so, Bill, maybe we can start with how was the tour this morning? How did you enjoy conversation with Jan Stalker?
Am I live?
You are live.
So is Jan. Jan is really quite amazing. I mean, I'd say two different things. First of all, it was a really informed and informing discussion of how to think about the large language models, generative AI, both the limitations on the one hand, but also the ability. They've developed tools in that lab, in the Sky Lab here at Berkeley, for evaluating and comparing the performance of the different big models. And as has occurred before in the software industry, the original proprietary closed system, ChatGPT, and others of that sort, are being pursued and competitively being approached by the open source system. We've seen this before. I mean, Tim O'Reilly, you all know who Tim O'Reilly is. One of the other things I am is Tim O'Reilly's outside board member. So I've had an incredible view of the last 25 years of the evolution of all things digital. Tim used to say to an audience like this is 20 years ago, he said, which of you use Linux? And nobody would raise their hand. And he said, any of you ever do a Google search? All the hands went up. He said, guess what? You use Linux. And this kind of way that technology emerges and disseminates and it gets deployed, it takes a lot of time. I think that your relationship, Race's relationship with Jan and with the Sky Lab, is an asset of extraordinary value. And it actually goes beyond, the specific investments, as fabulous as Databricks is and promising as opaque is. But that relationship, having that kind of perspective from deep inside where the innovative technology comes from. A long time ago, I had an radically unfair advantage as a venture capitalist because I had that kind of relationship at Xerox PARC, particularly with John Seeley Brown, the somewhat legendary director of Xerox PARC. So I had a vision of both what was possible now, but about the roadmap, the long-term roadmap going forward. And I think that's what Race Capital has with Skylab and Jan. It was a wonderful morning.
And we're very, very thankful to Berkeley and Jan and the Sky Labs. On this note, you also teach in Cambridge. Do you think that, particularly in Silicon Valley, how there's so many open source, like Spark, which become Databricks, and is it unique to Silicon Valley? Do you see that in the UK also?
Oh yeah, I think you see it everywhere. You see it You see it on the continent of Europe as well, where there's an awful lot of really smart people. You know about Mistral, for example, in Paris. Cambridge is probably the leading, but not the only source. This is Cambridge University, old Cambridge, as we like to say, not that upstart in Massachusetts.
What?
Cambridge is probably the most productive, most advanced source. It's where Microsoft put its first research center 35 years ago outside of the United States. But there's also, there's some terrific work going on at Oxford. I'm allowed to say that. Imperial in London, Manchester. Edinburgh was one of the first great sites of what was then called AI, just like this totally different technology. In fact, one of my best friends went to Edinburgh from Berkeley 40 years ago, and he's just going emeritus now. So there's a lot of that, and it is the case that a proprietary software program is, among other things, a kind of map for people like Linus Torvald, who can see what they need to deliver and what a kind of architecture for delivering it can be. So by and large, closed proprietary is pursued by open, and I don't see any way to think that's going to stop.
This morning, a lot. What Jan touched on is LLM, Gen AI, which is sort of the hottest topic. Switch to put your investor hat on. 10 or 15 years ago, as VC, we often see, the Uber for this and Uber for that, and it seems like these days it's Copilot for X, Y, and Z. Do you think what's going on now, Gen AI, is in a bubble, or is it for real?
Well, those are not contradictory. You can have both at the same time. The late 1990s was a bubble, but the development and deployment of the sort of technology, and BEA, of course, was in the forefront, that would transform the internet from a medium for communications to a medium and environment for transactions at very large scale. That was real, even though the companies that were doing it came to be valued transiently, temporarily, at prices, at values that could not be justified by their actual current or prospective cash flows.
So you're saying OpenAI is overvalued then?
Well, the good news is I don't have to bet on that. What I will say is that whenever there are ways to tell you're in a bubble, right? One is when the price goes up, and I'm actually an economist, that was my training, it's my doctorate. When the price goes up, demand is supposed to drop, right? That's supply and demand. Supply is supposed to increase, the price brings out more supply, and it chokes off demand. You're in a bubble if, when the price of the stock goes up, demand for the stock increases. And when that happens, you've got a choice. Are you going to ride the bubble as far as you possibly can, or is good enough good enough? And as the price rises, do you realize your investment? You can't do it all at once. I had, again, this is a kind of unfair advantage, a long time ago, I wrote my PhD thesis on 1929 to 1931. I hope everybody knows what happened in 1929, greatest stock market crash in history. So in 1999, I'd seen the movie before. I know how that movie ends. So at Warburg Pincus, where I was leading the technology group, we realized we sold our portfolio into the bubble. If you don't do that, when the bubble bursts, there are two categories of investors, the quick and the dead. So we've just come out of, and this I think may be a really useful topic for the founders as well as for LPs in the audience. We're just beginning possibly to see, after 2 years, the reopening of the possibility of taking a private company public, taking a high growth, high tech, venture-backed company public. But we have to read the state of the IPO market in two very different lenses, and it's hard to do this. One is the kind of cycle, and I got into this business back in the 1970s when there was no IPO market for 6 years in the 1970s. Then
Wow.
two great companies went public in December 1980.
Microsoft.
Apple, no.
Oh,
Apple, and you know what the other one was? Genentech, first biotech company.
amazing.
Microsoft went public in 84. So from then, we've seen these opening and closing, rising and falling valuations, money coming in from institutional investors, sometimes money coming in, usually late and silly, from retail investors. That's also a signal. And that will come and go. Now, the most recent, 2021, was the culmination of something we'd never seen before.
Yep.
We'd had almost 10 years of negative real interest rates, the interest rate below the rate of inflation, pulling an enormous amount of what people call the non-traditional investors, hedge funds, mutual funds, sovereign wealth funds, into investing in late-stage venture. When interest rates went back up, a lot of that money retreated. But that's still cyclical. That money will be available. But something else has happened in the last 25 years. There's been a major structural change in the venture, the financial ecosystem for venture capitalists and the companies they invest in. Back in the 90s, it had taken about 20, 30 years, there was a kind of environment in which there were dedicated intermediaries. We used to call them the four horsemen, four specialist investment banks.
And who are they?
Alex Brown, Hambrecht and Quist out here, Robertson Stevens out here, Montgomery Securities, yeah, that's Montgomery Street in San Francisco, and then back in New York, L.F. Rothschild, Underberg, Tobin.
And then what happened to them?
Well, their owners, the people who built those firms, they weren't stupid. As the bubble of the 90s exploded, their valuations, their business exploded, the IPO market became enormous, and the big banks wanted to get in. They all sold their firms to big banks. And guess what happened when the bubble burst? The big banks weren't really interested. So now, it used to be you could have a competition between those five firms for a company that had reached, let's say, 30 million in revenue, that had a valuation, let's say, 150 to 200 million. The IPO size was maybe 15% of that valuation, only about $25, $30 million. You could do an effective IPO, and you had investors who would come in knowing they weren't going to have a lot of liquidity. The stock was going to be basically one market maker, the lead underwriter of the deal. When those firms went away, and access to the IPO market is now owned by JP Morgan, Morgan Stanley, Goldman Sachs, maybe one or two others, Bank of America. To get their attention, you have to be talking about at least a 200, if not a $500 million IPO. And when you roll that back, the size of the company, that even under, let's say, speculative, if not necessarily bubble conditions, it is the case, and I appreciate the valuation of Databricks, but 10 times revenue is a high valuation for even a substantially growing company over time. So you have to have a company that's reached well over 100 million. If it's annual recurring revenue, the revenue multiple should be higher than one you were selling proprietary licenses. But it does mean that the path to IPO is much longer. You also have to be a bigger company because you have to be able to afford the cost of regulatory compliance.
Yeah, and I noticed before this, I really study a lot of your writing, and I also started to notice, let's say like the Yahoo or the BEA or the Microsoft is really just 3 or 4 years before they go public from founding. And nowadays we're seeing sort of the Uber was like 10 years, and it's getting longer and longer. So what you're saying is these banks disappeared, and then also the threshold to go public is much higher now.
Right.
So for how many founders is in the room? How many of Okay, so for a few of these, they need to basically hang on there for another 10 years or so.
It will be very, it is the case, I had to tell you guys, but even including the years of the dot-com bubble in the 90s, 80+% of all successful exits by venture investors have been M&A, not IPO. IPO has always been the exception. To build a company that can become public, if it has to be a $200 million, $300 million recurring revenue, that in and of itself takes time.
Yep.
It also means building the comprehensive management resources, both to grow and to manage. And then it needs a third thing, in my opinion. And this goes back over not just talking about the unicorn bubble and phenomenon, or even the dot-com bubble. The best way to hedge against the radical uncertainty with which we all have to live. Are we going to have another COVID? Is there going to be something in the South China Sea that's unpleasant and disrupts things? I don't know. Neither does anybody else. But the greatest source of hedging against uncertainty is when you reach the stage that your customers are giving you more cash than it costs to develop and deliver what you're selling. That's called positive cash flow from operations.
Magic formula.
You're paying your bills because of the stuff you sell, not the stock you sell. So with that, having that, it doesn't have to be immediate. If you have a plausible path, if you're building a customer base in a market large enough with technology that's distinctive enough for persistent competitive advantage, you don't have to be generating positive cash flow today, but being able to show your investors and your customers that you're on a path towards that promised land and the ultimate hedge against uncertainty. That's really, it doesn't seem to matter when you're in an environment like 2020 or 2021 and people are throwing cash at you with no interest in governance. They promise they won't go on your board. They promise they won't check what you're up to. And sometimes that can lead to, the people they're backing. I mean, two of the greatest venture capitalists ever, John Doerr and Mike Moritz, backed Larry and Sergey. And boy, that paid off.
Yep.
And maybe a little more controversially, a range of investors backed Mark Zuckerberg, and that paid off. But also in that kind of environment, you get Adam Newmans and Elizabeth Holmes and Travis Kavalnik. By the way, one reason it took Uber so long was that the really terrific people at Benchmark, I mean, I've known these guys since they started the firm. It's a great firm. I agree, he's not a crook. But the path to IPO led to, by way of Benchmark, suing the company to force out the CEO. That's what took time.
Bill obviously have no opinion about anybody, but I think for our founders in the room, I think it's great to remember that great company is bought, not sold, and focus on positive cash flow and great companies.
As you build the company, think about the channels and the barriers to reaching positive cash flow. If you have access to more capital than you thought you might, you can accelerate that process. That's perfectly legitimate. An old saying in the business, when they're passing the cookies, take all you can, because there'll come a time when there are no cookies available.
I love some cookies.
You want some cookies?
I love some cookies. Maybe quickly switch topic away from being an investor. We are sitting in Berkeley. I know you have a lot of experience investing in companies that was previously open source and then somehow commercialized open source software. I would love to hear your thoughts around just in general how we should think about when we are looking at companies like that. And on top of that, what do you comment on Microsoft OpenAI being closed source?
Well, first I'd say that there's a long history, as I said already, that when somebody produces an innovative software program, that it becomes it establishes a kind of roadmap for followers. At BEA, we were followed by JBoss, which is kind of complicated. It forced us to keep innovating. And Alfred in the lead, we did, and BEA stayed ahead. But there is this kind of sound of the hooves behind you. And then just this morning at the Skylab, we were shown this tool that the guys there have developed, Jan and his students have developed, for evaluating the performance of these different models. And, you know, Llama 3, which just came out, is really close to ChatGPT, and it's completely open source.
Yep.
So it's hard to maintain the kind of, you know, if you invent a new drug and you get through the clinical trials and you manage to get access to the $2 to $3 billion it takes and the 15 to 20 years it takes to have a patented therapeutic pharmaceutical on the market, you're protected until the patent runs out. That's not true in the software industry. It's never been true in the software industry. So you've got to keep running. You've got to keep innovating. In the books I sign for friends or friends of friends or friends of friends of friends, I always put, keep innovating.
Yeah.
That's the only, there's no alternative. There's no escape from that. When you stop, we saw, I mean, I spent 20 plus years at Warburg Pincus investing in, for the purpose of helping to accelerate IBM's loss of control of commercial computing. In 1980, they owned it. By 2000, they were irrelevant. And that was because they stopped innovating. They let the world run past them.
At one point, they were doing $14 billion.
No, IBM was doing 100 billion, way over 100 billion in revenue. You're talking about the one product, the most successful,
AS400.
the most successful computer product ever introduced, hardware product. It's called the AS400. It went from 0 to 14 billion in revenue in 3 years. It generated $10 billion of free cash flow, and it was completely closed, completely proprietary, completely inaccessible to the masses of technology growing up around Unix, around Ethernet, around first client server, then local area network computing, then wide area network computing, and then internet computing. And IBM just got completely left in the dust.
I love that. Bill is like a walking encyclopedia to me. Bill, the other day, I have a lot of sort of pre-written prompt that I put in ChatGPT, usually work pretty well and it really increased my productivity. But the other day, I just one time, it actually came back and say, why don't you just do it yourself? I couldn't believe it, and I was scared.
Actually.
So with that, do you think AGI is coming?
Not in my lifetime. And maybe not in any of yours.
Okay. All right. I think we're at 3 o'clock. I'm always trying to be on time. I want to actually open up for questions. And of course, my best friend Dave. Any questions? First question.
Okay, the question was, we saw an enormous expansion in private capital markets in the years leading up to and through 2021. What do I see going forward? And in particular, and I think this is the absolutely crucial question, will liquidity be available in the private markets without having to go public? Well, the first answer to that is that's not entirely up to the private markets. Maybe the Supreme Court will call into question the constitutionality of the Securities Exchange Commission. I kind of think that's unlikely, although there's at least 1 or 2 members who want to take the United States back to the Coolidge administration in the 1920s before the SEC. I think the likelihood of having broad-based liquidity for private companies is a regulatory issue. And I think it's unlikely to be sanctioned. I think that the whole point of prospectuses, and in fact, we've had a little experiment with this, with the SPAC phenomenon, another signal, you know you're in a bubble, when people are saying, give me your money, and I have no idea what I'm going to do with it, but it's going to be wonderful. So we've seen some, but I think you're getting a little close to the edge where if you want that stock to be traded with any degree of liquidity, you're going to have to provide a lot of information. You're going to have to be subject to 10b-5, no misleading statements or failure to correct, to disclose all material information and no misleading statements. That's what the IPO process is essentially about. So I think that we've clearly seen withdrawal of the late stage non-traditional investors from the scale that they were operating at. I mean, I read the quarterly NVCA reports. I teach a course on venture capital and the economics of innovation. I constantly am updating the data on late stage valuations, volume of late stage investing. It was as if you threw a switch on January 2nd, 2022. So for the most exceptional companies, there will continue to be some capital available at higher valuations from non-actively engaged investors who want to participate. We've got this little exercise. I don't know, anybody here know who Matt Levine is?
He's amazing.
He writes a column called Money Stuff for Bloomberg. He has a good podcast now. He just does have a good podcast, but if you read the article, frankly, I just listened to the first one. It's redundant. But he's got his eye on this thing called, oh Lord, what is it? It's not infinite. It's a publicly traded closed-end fund that has $50 million of positions in private companies. The first day it traded, it was being valued at 200 times the net asset value. It's down to below 100 times. Wow. It's all retail investors. It's meme stock investors. He said in his column, in his first column, he said, hey, guys, you got this stock at this price. Sell more stock. And now they announced they're going to sell $1 billion worth of more stock. Wow. And of course, the price as a result is declining. And it does illustrate that there is a demand for getting in earlier, but there is also, as we've seen, for what is now the SEC set up shop in 1934, so it's now 90 years of experience as to why the New York Stock Exchange and NASDAQ and the American capital markets have been the predominant markets in the world. And it's been because you simply have a greater degree of trust. And that's a function of the regulatory environment. And so I don't think we're going to have a sort of back to the way things worked in the 1920s, which was Wild West. Well, you have firms there, as we've seen with the private equity, the buyout firms. You reach a certain scale. It says, will venture firms go public? With the best will in the world, you've seen the migration from what were once upon a time within living memory, certainly within my living memory, firms who were investing in very early stage, like Race, investing in very early stage, very active engagement with startups out of funds that had 50 to 100 million in capital. Now those funds, those firms are managing tens of billions of dollars. It's a different business. I saw it happen at Warburg Pincus. When I was investing in the 1990s, we were investing out of a fund with it was huge by those standards, it was $1.5 billion fund. The last fund Warburg raised was $17 billion. They're not doing startups. So the firms that have gone public, like Carlyle and such, in a way, their asset gathering versus their investing activities kind of dominate. And there is and I'd say this, to my friends at those big PE firms, there is a kind of conflict apparent between the shareholders of the public company and the limited partners of the funds. Who are you running the firm for? I think the old-fashioned venture model, and I say this not just because I'm an LP, where the alignment of interest between the general partners and the limited partners is the dominant concern, I'm an advocate of that.
How about we do one more question and we go on a break? Going once, twice? Don't be shy. Really, no.
Okay,
This gentleman.
We got some winners down here.
Yeah. And do you think that psychologically they just don't want to because they're scared?
First, I'm not, obviously, you guys know the state of play at Databricks far better than I do, and I wouldn't dream of opining on the attitudes and the mental processes, and probably there are some quasi-political processes going on as well. I think that a company that has reached that scale does have choices. There are historically, in my experience, there have been several reasons for going public. One is, and it's not the only one, but one is that indeed, for the founders and for the early stage investors, the early venture people, it does provide the liquidity that they don't have as long as the company is private in any scale with any predictability. The other is that you create a currency for acquisitions, for mergers, that can be much more relevant, much more useful than cash. The long-term basis we've seen, I mean, look, the firms, the great companies, there are a set of great companies that have been private for well more than 100 years. Have you ever heard of Cargill? Cargill is a private company. Bechtel, based out here in San Francisco. Bechtel's been a private company for, I don't know, 120 years. You know, they built the Hoover Dam. So you can imagine a company that just determined. Now those grew up as family businesses, a little bit like the New York Times, or once upon a time the Washington Post before Jeff came to save it. I think that being able to renew that beyond sort of one active generation of founders is really hard. There's a long history. There's actually, as Edith knows, as Alfred knows, I typically have reading lists. And there's a great book, of all things, but it's totally relevant, about the history of banking in New England. It's called Insider Lending. Sounds like a bad thing. The first industrial revolution in New England, the cotton industry, the textile mills, they were funded by private banks that were started often by the same families, where the cousins would be building the mill and these cousins would be creating a bank. And the bank would fund what were high-risk investments. This is in the 1820s. This is creating the first manufacturing base in the United States. Three generations on, and the grandchildren, the great-grandchildren, I think it's great that the bank's been around for 3 generations. It's helped build funded some really good companies. But I'd like a little cash. So the banks go public on the Boston Stock Exchange, which was a big deal in the late 19th century. The inheritors, the descendants, get their cash, and the banks become an entirely different kind of institution. Now they have public stockholders. They can't lend to their first cousins on favorable basis, where they can trust the first cousins, because otherwise grandpa will cut them down at the knees if they default on their debt. It becomes a completely different business. So that's the kind of, there are real reasons why we can almost count the great companies that have been private for more than one generation.
With that said, Bill, I can sit here all day long on the director chairs talking with you, but time is up, and we're going to do a quick 15-minute break, and you guys are welcome to ask more questions. And we only have unfortunately, we only have a few books of your books, and hopefully we'll sign it for our other speaker. But
Available on the Amazon website near you.
thank you, Bill.
You bet.
Thank you.